Stop what you're doing, close the charts, ignore the indicators, look at the number glowing on your screen right now. If you're watching Western Feeds, London Fix, or COMEX, you're seeing silver around $71 per ounce. It looks calm, it looks controlled, it looks like nothing is wrong with the system. Technical analysts are drawing trend lines, calling this consolidation, calling it healthy price action. I'm here to tell you that number is not just wrong, it is fake. It is a ghost price from a market that still thinks it's alive. Because while your screen says 71, the real world is already somewhere else entirely. Right now, on the streets of Japan, physical silver is trading at a completely different reality. Not futures, not ETFs, real metal, bars you can touch. Confirmed reports from dealers in Tokyo show retail silver selling for 20,000 yen per ounce. Let's convert that calmly together with no drama. At today's exchange rate, that equals roughly $130 per ounce. This wasn't a sudden accident. It was the end result of years of quiet pressure, hidden leverage, and a market stretched far beyond reality. For decades, silver prices were not discovered naturally. They were managed, guided, and restrained through layers of paper contracts and promises. On paper, silver supply looked infinite. In reality, the physical metal was quietly disappearing from vaults, refineries, and global inventories. Every futures contract created the illusion of abundance, even as real bars were shipped east and never returned to Western exchanges. This imbalance grew slowly, almost invisibly, until one day the numbers stopped making sense to anyone paying attention. The market functioned only because trust remained intact, trust that paper claims could always be converted into physical silver. But trust is fragile, and once it cracks, markets don't adjust gradually, they snap violently. Behind the scenes, industrial buyers began noticing delivery delays, rising premiums, and unexplained shortages in wholesale markets. At first, these were dismissed as logistical issues, temporary disruptions, nothing systemic, nothing to panic about. But insiders knew better. The supply chain wasn't delayed, it was depleted. Silver wasn't flowing through the system anymore. It was being hoarded, stockpiled, and locked away permanently. Meanwhile, the paper market kept expanding, creating claims on metal that no longer existed in sufficient quantity. This is how fragility is built, quietly, legally, and with everyone pretending the structure is still sound. By the time the warning signs became visible to the public, the damage was already irreversible. A single shock was all it would take to expose the entire illusion. And that shock didn't come from retail investors or online forums. It came from sovereign demand, industrial necessity, and governments prioritizing survival over free markets. When physical silver stopped being optional, price discovery stopped being negotiable. At that moment, the paper market lost its authority. What followed was not volatility, it was the beginning of a structural breakdown. The first visible cracks appeared in places most investors never watch: delivery reports, warehouse withdrawals, and refinery order books. Numbers that once moved slowly began shifting faster, then all at once, without headlines or official explanations. Large buyers stopped asking for exposure. They demanded metal, immediate delivery, no substitutions, no delays. That single change transformed silver from a financial instrument into a strategic resource overnight. Exchanges were not designed for this reality. They were built on settlement flexibility, not physical urgency. Every request for delivery tightened the system, pulling metal away from an already fragile supply chain. Warehouse stocks fell below psychological thresholds that traders quietly monitor, but rarely discuss publicly. Once those levels were breached, confidence began leaking out of the system. Market makers widened spreads, reduced size, and hesitated where they once provided instant liquidity. Volatility rose, not because of speculation, but because nobody knew where the real clearing price existed anymore. Price signals became distorted, flashing contradictory messages across futures, spot, and physical markets. What should have been arbitraged smoothly, instead, revealed deep fractures between paper contracts and real metal. The disconnect grew too wide to ignore. Premiums exploded while official prices pretended nothing was wrong. This was the moment professionals recognized a regime change, even as the public remained unaware. Banks adjusted risk models, not upward, but defensively, preparing for disorder rather than opportunity. Credit lines tightened, margin requirements shifted, quiet warnings circulated behind closed doors. Yet none of this appeared on mainstream financial news feeds. From the outside, silver still looked calm, stable, and controlled. Inside the system, however, participants were scrambling to secure exposure that could actually be honored. This scramble didn't push prices immediately. It drained availability instead. Liquidity vanished first, price followed later. By the time charts reflected stress, the physical market had already crossed a point of no return. At that stage, no amount of reassurance could restore balance. The system wasn't mispriced, it was misconstructed. And structures built on leverage don't bend gently when reality intrudes. They fail abruptly, transferring risk to whoever remains exposed at the end. Silver was approaching that edge faster than most realized. The only remaining question was not if the break would happen, but who would be trapped when it did. The moment panic truly began was not when prices spiked, but when deliveries quietly stopped being guaranteed. Contracts were still trading, but fulfillment timelines became vague, conditional, and increasingly negotiable. What had once been firm obligations slowly transformed into discussions, extensions, and alternative settlement offers. That shift sent a clear signal to insiders. Physical silver was no longer readily available at any posted price. Buyers stopped asking how much silver cost and started asking whether it could be sourced at all. This is when rational pricing breaks down and survival instincts take control. Industrial users faced an impossible choice: secure metal at any cost or risk shutting down entire production lines. Inventory buffers vanished faster than forecast models could adjust. Supply managers escalated orders, not to speculate, but to prevent operational collapse. Each emergency purchase tightened the market further, feeding a self-reinforcing spiral. Meanwhile, futures prices lagged reality, broadcasting calm where none existed. This delay created a dangerous illusion that the situation remained under control. Behind closed doors, exchanges activated contingency protocols they rarely acknowledge publicly. Settlement flexibility expanded quietly, signaling stress without triggering headlines. The gap between official prices and real-world availability widened by the hour. Premiums surged in private deals, unreachable to most participants watching public charts. Liquidity providers began stepping back, unwilling to warehouse risk they could not hedge physically. As bids thinned, price discovery lost its anchor. This was no longer a market, it was a negotiation under pressure. Every transaction carried uncertainty about delivery, timing, and counterparty reliability. Trust, once broken, could not be repaired with reassurance. Participants rushed to reduce exposure, even at unfavorable terms. Selling paper positions became a race to exit before settlement realities surfaced. Volatility finally exploded, not as speculation, but as delayed panic reaching the surface. Charts reacted violently, struggling to reflect conditions that had existed for weeks. By the time the public noticed, professionals were already repositioned. Retail investors arrived late, drawn by headlines rather than supply data. They saw a price spike. Institutions saw a systemic failure unfolding. At this stage, intervention became inevitable. The only question left was who would intervene first, and at what cost to the market's credibility. Intervention did not arrive with press conferences or emergency headlines. It began quietly, through policy adjustments and administrative controls. Certain flows were slowed, redirected, or paused entirely under the justification of market stability and national interest. Export approvals tightened, strategic stockpiles were reviewed, physical silver became a matter of policy, not commerce. These actions weren't coordinated publicly, but they didn't need to be. Markets react to incentives, and incentives had just changed dramatically. Exchanges responded by modifying contract terms, margin rules, and delivery options under the language of risk management. What was once standardized settlement became conditional, flexible, and increasingly discretionary. This preserved surface-level order while eroding the foundation of price discovery. Banks followed with balance sheet protection, reducing exposure to anything requiring physical fulfillment. Credit availability shrank precisely where demand for certainty was highest. Industrial buyers found themselves competing not just with investors, but with governments. At that point, price ceased to be the primary rationing mechanism. Access became the constraint. Paper prices stabilized temporarily, creating the illusion that intervention had succeeded. In reality, physical premiums continued climbing outside visible markets. This divergence signaled a fundamental break between financial representation and material reality. Officials framed these measures as temporary safeguards. But temporary controls have a way of becoming structural once markets adapt around them. Participants adjusted behavior accordingly, prioritizing relationships, jurisdiction, and political alignment over price. Silver began trading in two distinct systems simultaneously. One visible, liquid, and increasingly abstract. The other opaque, physical, and governed by power rather than transparency. Arbitrage between these systems became impossible without unacceptable risk. That breakdown removed the final stabilizing force in the market. Without arbitrage, prices no longer conveyed truthful information. They conveyed policy intention instead. This is how markets stop functioning and start signaling control. The longer this condition persisted, the harder normalization would become. Confidence didn't return, it relocated. And when confidence relocates, capital follows in ways charts cannot predict. Price did not reset through a single explosive candle. It reset through a series of quiet refusals to sell. Sellers disappeared first, not because price was low, but because future availability was uncertain. Without sellers, posted prices lost relevance almost immediately. Transactions shifted off-screen, negotiated privately between parties with leverage, access, and jurisdictional protection. These deals referenced official prices only loosely, treating them as outdated guidelines rather than binding signals. The true clearing price emerged indirectly, through premiums, delivery timelines, and political alignment. Silver was no longer priced in dollars alone. It was priced in reliability, in speed of delivery, in guarantees that could actually be enforced. For those inside this new regime, price volatility felt irrelevant. What mattered was continuity of supply. Outside observers saw charts stabilize and assumed the crisis had passed. Inside the physical market, availability continued to contract. This divergence marked the true price reset. Not a revaluation upward, but a redefinition of what price even meant. Metal that could be delivered immediately commanded an entirely different valuation. Paper exposure, no matter how liquid, was discounted accordingly. Two prices existed, but only one cleared reality. The other existed to maintain the appearance of normalcy. Over time, participants adjusted expectations downward for liquidity, upward for certainty. This adaptation hardened into a new equilibrium. An equilibrium defined less by efficiency and more by control. Markets stopped asking where silver was cheapest. They asked where silver was obtainable. That shift permanently altered capital allocation decisions. Entire supply chains reoriented around access rather than cost optimization. The consequences extended far beyond precious metals. Silver had exposed a flaw embedded across modern financial markets. Once exposed, that flaw could not be ignored again. This story does not end with resolution, because systems like this rarely resolve cleanly. They adapt, harden, and continue operating under new rules few fully understand. The silver market did not collapse in flames. It quietly revealed its true architecture. Those who relied on price alone were left confused. Those who understood structure were already positioned elsewhere. This was never about silver itself. It was about what happens when trust is abstracted, leveraged, and finally tested by reality. The question now is not what silver is worth. The question is which markets still deserve to be believed.